Is Bank of America's money worth more than your own? Would you value access to your own capital at a lower rate than you'd pay to them? Like, is their money worth more than your money? You can't build wealth if you're constantly rating your own system and then you're lax about putting it back. If I'm paying myself back, say 6%, but the insurance company's only charging 5%, where's that extra 1% go? This is probably where most people sabotage themselves. They pay off the loan early, feel like they won, and then. Hey everyone, Brian Moody here with Remnant Finance. Today I want to revisit something that trips up a lot of people when they're learning about the infinite banking concept, and that's loan repayments. Specifically, I want to talk about why we pay ourselves back, what EVA actually means, and why you should be paying yourself market rates for the full duration of loans, and what to do when you're paying yourself more than what the insurance company is actually charging you. And this is where a lot of people, they kind of get confused, and honestly it's where a lot of bad advice gets circulated online. So I'm recording this solo today, so we're going to dig a little bit deep into this topic, and let's get into it. When you take a loan against your whole life insurance policy, you're not actually withdrawing money from your cash value. That's kind of clear. The insurance company is lending you their money using your cash value as collateral. Your cash value stays in the policy, so it continues to earn dividends and guaranteed growth. And we've spoke at length about the mechanics of a whole life policy loan, why it's the best type of loan in the market. So you're in control of the repayment schedule. The interest only capitalizes yearly, meaning you make 100% principal payments and the interest is charged and rolled into the loan only once a year. But here's where it gets interesting and where your behavior becomes critical. There's a concept in economics called EVA, economic value added. It's simple but really powerful. Did the thing you finance with this loan produce more value than the loan cost you? So if you borrow at 5% and the asset returns 8%, you've created positive EVA. You've added economic value. You're ahead. If you borrow at 5% and the thing depreciates or returns nothing, you've created negative EVA. You're behind the curve. And this is basic finance, but people forget it when they get excited about being their own banker. And here's where people go sideways. They think because they're paying themselves back, the interest rate doesn't matter. Or worse, they think they can just skip repayment entirely because it's my money. Wrong. Dead wrong. And let me explain why. As a part of the EVA principle, Nelson Nash in Becoming Your Own Banker recommends that you pay your loans back to the insurance company at market rates, even though you may have access to your capital at a lower rate with the insurance company. I mean, is Bank of America's money worth more than your own? Would you value access to your own capital at a lower rate than you'd pay to them? Like, is their money worth more than your money? So when you're paying back at market rates, what the market demands, it means rates comparable to what you'd pay elsewhere for similar financing. You're maintaining the discipline that creates wealth. And think about it. If you could borrow from a bank at, say, 6% for a car, and you decide to pay yourself 6% instead, even if the insurance company is charging you 5%, you're valuing your dollars the same as the bank's dollars. You're keeping that interest payment inside of your family banking system instead of sending it to Chase or Bank of America or Ford Credit or whatever. But if you say, well, I'm just going to pay myself back whenever, however, you're not banking, you're just spending. And truthfully, you become the worst kind of bank, one with no standards, no discipline, and ultimately, no capital. Uh, Nelson also recommended that you pay the loan back at the full duration. So even if it's paid back to the insurance company at a faster rate by paying higher interest rates. Now, why the full duration? Why not just pay it back early and call it good? Well, here's the thing. The discipline of structured repayment over the full loan term does three critical things. One, it forces you to maintain positive cash flow discipline. You can't build wealth if you're constantly rating your own system and then you're lax about putting it back. Number two, it ensures that your policy continues to compound effectively. When you're making regular systematic repayments at a marking rate, you're creating a forced savings mechanism that's going to rival or exceed what was there before. And number three, it's going to teach you how to think like a banker. Banks don't say, pay us back whenever. They have terms, they have rates, they have standards, and those standards are what keep them in business generation after generation and allow them to expand. So let's create a quick example. Say you take a $30,000 policy loan for a car at 5% over 5 years. Your payment, it'd be about $566 a month. Over 5 years, you'd pay about $33,968. So let's just round that up and say $34,000. Now that's like 3,000, or that's about $4,000 in interest. So now if you'd paid cash from outside of your policy, that $30,000 would have stopped compounding. But because you kept it as collateral and you took the policy loan, it kept earning. It kept earning guaranteed interest and dividends. And let's just say that number's 4%, guaranteed growth plus dividends. Well, over the course of those 5 years, that original $30,000, because it wasn't disrupted, would now be worth $36,500. Remember, we paid $34,000. So that's $2,500 more in the policy after it's paid off than what you started with. And if we had just taken a loan, you would have simply paid $34,000. Or if you had paid cash, you would have just paid $30,000 and had no growth. So that extra $2,500, that's economic value added by allowing the compounding to continue. Meanwhile, you're paying yourself that $566 monthly through the course of those 5 years. So that money flows back into your cash value where it's accessible again, much like a line of credit. So do you see what's happening? You've created a circular flow of capital that's actually growing and expanding your system, continuing to give you access and control, but only if you maintain the discipline of full repayment at market rates. Excuse me. Now, here's where it gets really interesting. And this is a question I get all the time. Brian, if I'm paying myself back, say 6%, but the insurance company's only charging 5%, where's that extra 1% go? And if I'll pay off the loan faster, right? Well, great questions. And let's break it down. First, yes, mathematically, if you're paying a higher interest rate than what the insurance company's charging, you will pay off the loan balance faster, especially when we consider the efficiency of a policy loan where every repayment is a principal repayment until the end of the policy year when they then finally capitalize and tack the interest charge on. So way more efficient than an amortized loan. So you're going to pay it off even faster than if you were paying extra interest on an amortized loan. So the higher rate means more is going to the principal early. The loan gets satisfied quicker. But here's what you need to understand. When you make those payments back to your policy, that money goes into your cash value either as paid up additions, PUAs as we call it, potentially as premium payments, depending on how your policy is structured and if there's room for those PUA payments. So that extra interest you're paying yourself, it's not going into some like special bucket somewhere labeled interest. It all goes back at some point eventually into your policy. You could do that a couple ways. You could just take that extra 1% every month and maybe buy some PUAs, or you could even like at the end of the term keep making those payments and pay a whole bunch of PUAs. But there's another scenario which I'll talk about too where your PUAs are already paid up. What do you do then? But the point is, it's all going back into your policy, increasing your cash value, and then it continues to compound and grow for your benefit. I mean, it's awesome. So think of it this way. When you write that check back to your policy or make the payment, the insurance company doesn't really care that you calculated at 6% when they're only charging 5. You have complete flexibility in how much you pay back and when you pay it and at what rate you pay it. They're just going to charge you a certain interest at the end of the year. They just see like all they're seeing is like, here's a payment that's reducing the loan balance and reopening or pulling the lien off of the cash value. You can think of it that way. The loan balance goes down according to the insurance company's rate, or according to what that balance is. But you're paying more than the minimum required. So you'll simultaneously paying off the loan faster, including the interest charge, adding more capital back into your policy than you borrowed by the end. And it's actually a beautiful thing if you think about it correctly. So the follow-up question is, if I'm paying a higher rate and I'm going to pay it off faster, should I continue making those same payments for the full original term? Like if it was a 5-year car loan, but I pay it off in 4 years, should I keep making payments all the way through the fifth year? And my answer is absolutely yes. Here's why. You established that payment as part of your cash flow system. You told yourself for the next 5 years, $566 a month goes into my banking system. The fact that the loan is satisfied early doesn't change the commitment you made to capitalize your system. In fact, this is probably where most people sabotage themselves. They pay off the loan early, they feel like they won, and then that payment just disappears. Well, where's it go? Probably gets absorbed into lifestyle, into spending, into nothing. I shouldn't say nothing, but into nothing that's really advancing their wealth system. That's Parkinson's law in action. What Parkinson's law, if you recall, it says that expenses will rise to meet your income. Your spending will ultimately expand to fill whatever space you give it. So if you maintain that payment for the full 5 years, even though the loan was paid off in 4, now you're just building pure capital. You're strengthening your system. You're preparing for the next opportunity, which kind of brings me to the next critical question. Brian, my PUAs are already maxed out. The policy won't accept any more paid up additional premium. Where do these extra payments go? And it's a real scenario that people hit, especially if they're aggressively capitalizing their policies, or if they've designed their policies to to be already heavily PUA loaded from the start, or they paid it up front, anything like that. And so here's how should kind of think about it. The first option, apply it to next year's premium. So just set it aside, right? Let's say you're currently in year 5 of your policy and your 6th premium is coming up. Bank that extra payment, put it into a high yield savings account somewhere earmarked specifically for that future premium. You're essentially like pre-funding your bank system right now. And when the premium comes due, boom, there it's already there. Send it in. No cash flow is disrupted. Your second option, hey, if you're just like piling up cash somewhere, maybe it's time to expand your policy system. Time to do a new policy. Maybe your spouse needs one if you have one. Maybe your kids need one. I mean, that excess capital can seed the next branch of your family banking system. Remember, like the Rothschilds, much as I don't like them, but they didn't build their wealth with one bank. They built a network of capital. And your third option, deploy it into your business or some other wealth building opportunity. Like Hans and I have talked about some of the things we do. We're into real estate and we're now into the low stress trading. Like maybe you've got a place to deploy it there, but put it into some kind of wealth building asset. And this is critical. That money, if you have that extra year of payments coming now into your life and you don't have anywhere to put it, it needs to be productive capital. It shouldn't become consumption. If your business needs equipment, maybe there's a marketing campaign that will generate a good positive ROI. There's a rental property opportunity. You're doing this trading somewhere with cash flow or some kind of economic value added. It doesn't go to a nicer car, bigger TV. It's not for vacation. Those are expenses. They're somewhere else in your budget. Like we're talking about capital deployment here. So how are we going to properly deploy that capital to continue building wealth? And that's where discipline is going to separate the wealth builders from everyone else. Like Parkinson's law, again, it actually states that work expands to fill the time available for its completion. The financial corollary of that is spending expands to consume the income available. So if you suddenly have an extra $500 a month because you paid a loan off early and you don't immediately redirect it, I promise you it's going to vanish. You won't even know where it went. You'll eat out a little more, you'll buy some new clothes, you'll upgrade your phone, you'll just frivolously spend $5 here, $5 there, $20 here, $30 there. You'll say yes to things you would have said no to before. And 2 years later, making the same income, but somehow living paycheck to paycheck. That's our enemy. Nelson says that if we can overcome this, we win by default. Parkinson's law is what destroys generational wealth before it ever even gets started. So when you pay yourself a higher interest rate than the insurance company charges, you're not winning by paying off the loan faster. You're winning by forcing more capital through your wealth system. And when your policy can't absorb any more PUAs, you're not stuck somewhere like, what do I do with it? You're at a growth threshold. So that's when you expand, get a new policy, invest in your business, think next level. But the key is the payment amount you establish doesn't change just because the loan got paid off. That cash flow commitment remains intact and gets redirected strategically into the next component of your wealth building system. The temptation here, I would say, is like to think, hey, I could just put this back faster and save on interest. And here's the question though, like, by paying that off faster and saving on interest, like, say, interest paid to whom? At that point, you're paying it to yourself. You're not saving anything. You're just short circuiting your own system. And the power of IBC isn't in avoiding interest, it's in recapturing it and controlling it and keeping it inside your own ecosystem where it can constantly compound. Even when you're paying yourself more than the insurance company charges, you're still not losing that interest. Like, it's going back into your cash value, or I should say, rather than cash value, I should say, because that was never interrupted. And I'm actually saying something that's a little wrong there. It's going back into, whenever you make that payment back, it's re-releasing the lien against the cash value. But at any rate, it is building your system, which is the important thing. So now I guess some people might say, like, but Brian, what if I can make more money investing that payment somewhere else? And it's a fair question, one that tempts me, one that tempts just about everybody. And if it's true, if it's really good, like I say, do that thing and then use that thing to make the repayments. You're still going to make the repayments. But before that, because it's a sure thing, I'm going to say, like, when we think about family banking, here's kind of my answer. Like, maybe you can make more elsewhere, but you might be speculating right now. You're comparing a guaranteed, systematic wealth building process against some theoretical investment opportunity. And I got to say, historically, when people start making those trade-offs, they end up with neither. They don't build the banking system. The speculative investment system might not pan out. And the beauty of IBC, why we think of this as a family banking system, which we can use for investment, but make sure it's still getting paid back. The beauty of it is certainty, guarantees, compound growth, privacy. You only get that if you actually work the system correctly with discipline. Here's what some people miss. Like, infinite banking isn't about finding loopholes or shortcuts. It's about creating a family banking system that operates the same discipline and standards that made the Rothschilds, the Rockefellers wealthy. Now, I think those families are kind of awful in a lot of ways. But the truth is, they did this with discipline. They built banking systems, they built generational legacy. And when it just comes to that microcosm of their life, like, we can learn a lot from them. So, they weren't sloppy with their capital. They didn't loan themselves money and then forget about it. They treated their family banks with the same rigor that any successful bank in the world would demand. And when they pay off a loan early, they didn't take that money and blow it. At least, I don't think they did. They probably redeployed it. They expanded. They compounded. And that's what we're building for our families. So here's what that looks like practically. When you take a policy loan, immediately set up the repayment schedule. Treat it like any other loan. Put it on auto pay if possible. Make it non-negotiable. Like, pay yourself the same rate or even higher. I've talked to some people here that, like, they will just, any loan they take, they just automatically set a 10% interest rate. And this is a lot of the old school IBC practitioners that have done this, who knew Nelson and who, when he really drilled this into their minds, they would pay a much higher rate than they had access to. So pay yourself higher if you want. So let's say a car loan would cost you 6%. Pay yourself 6%. Pay yourself 8%. If you're being aggressive and want to accelerate your system, keep paying even more, up to 10%. That extra is going back into your system anyway. So Also, stick to the full term. 5-year loan, 5 years of repayment, even if the loan is satisfied early. 10-year loan, 10 years of repayment. Make your policy, or excuse me, when your policy maxes out on PUAs, have a plan. Know where that capital goes next. Premium reserves, maybe new policies, business deployment, just not lifestyle creep. It's not about being rigid for rigidity's sake. Like, this is about building a machine that works whether you feel like it or not. Because here's the truth: the people who succeed with infinite banking, those are the ones that are thinking in decades. We're thinking long range. One of Nelson's main principles. We're not thinking in quarters, months, weeks, days. We're thinking long range. We're building something for our grandchildren, not just ourselves. I think about my 4 kids. I think about the Moody family legacy. I think about what it means to create a financial system that far outlives me, provides capital and opportunity for my grandchildren, hopefully my great grandchildren, and on and on. And that kind of legacy doesn't happen by accident. It happens through discipline, structure, and systems that outlive your feelings on any given Tuesday. It happens when you treat every dollar like it has a job, and it has to do that job. When you refuse to let Parkinson's law steal your future. When you understand that paying yourself a higher interest rate, it's not about the rate. It's about the discipline of moving capital through your system consistently and permanently. So I'm going to give you another real world scenario. Let's say you finance a $40,000 truck, which is probably cheap right now in 2025. Let's say the bank would charge you 7% over 5 years. So that's about $792 a month. You take a policy loan instead. The insurance company is charging you 5%, but you decide to pay yourself the full 7% market rate. You're taking advantage of this principle of EVA. So you're still paying $792 a month. Well, I didn't figure this out in the policy loan scenario where we're paying 100% principal, but like looking at an amortized loan, if I were to do that, after about 4 years and 2 months, the actual loan balance at the insurance company would hit zero. And because of the efficiency of the loan, it's probably even faster. But for the principle of this example, it doesn't matter if it's a couple months faster. Like, we'll just look at like what an amortized calculator showed. So you've paid it off. Most people would stop and they'd think like, great, I've saved 10 months of repayments. But you don't stop. You keep making that $792 payment for the full 5 years. And in those extra 10 months, you've put another $7,920 into your policy. And that money immediately starts compounding and expanding your system. And you put that in the form of PUAs. But that's money available that's now available in your system for your next opportunity. Money that's growing your legacy, money that's expanding your system, your foundation. And here's the kicker: that discipline is what separates you from almost everybody else. Most people would have just absorbed that $792 back in their lifestyle. And 6 months later, they wouldn't even know where it went. So you just added almost 8 grand to your banking system, multiples of that into your death benefit, while simultaneously proving to yourself that you can maintain wealth building discipline. That's the difference between talking about IBC and actually building generational wealth with it. Now, let's say your policy it really is maxed on PUAs. You've paid everything up front. You have nowhere to put it. And you've been doing this for years. You're crushing it. And there's literally no more room at all to put any more PUAs in. Or maybe like the PUAs are cut off because it would have meched. And you're already at that point in the stage where you're only paying, the base premium. So first of all, like, congratulations. You've got it. That's what I call a high quality problem. But, here's like a potential of your decision tree. And I'm going to give you a few things, but remember, the name of this is the infinite banking concept. It's up to your imagination, your creativity. Like, there's a lot of other things you could probably do. Just remember, like, whatever you choose to do, make sure it's smart. But here's a couple things in your decision tree. Like, question one: is my next year's payment already secured? If no, park it in a high yield savings account, like I mentioned earlier. Earmark that for premium. When the bill comes due, you're ready, dude. No scrambling. Question two: does anyone else in my family need a policy? If yes, start it. Spouse, kids, key employees if you're running a business, grandkids, expand the system. No bank, Not well, very few banks. The most successful banks don't have one branch. They continue to add a new branch whenever they're successful. So we want to do the same thing. Question 3, do I have a productive capital opportunity with a clear ROI? If you do, and it's truly productive, do it. So if it's generating cash flow or it appreciates reliably, deploy that money there. Just be honest with yourself. Like, I want to upgrade my kitchen. That's not a productive capital opportunity. I understand it can add to the value of your house, but that's a spending opportunity. That's in another bucket. We're thinking of the things that go through and into and through this system as our wealth building money. Uh, have a rental property that will cash flow $300 a month. That is a good capital opportunity. Question 4, I talked about the family. Maybe you should start another policy on yourself. And if you've legitimately maxed out your current policy, you have consistent cash flow to support it, adding another policy creates more banking capacity, more collateral, more options. I'll tell you, but here's what you don't do. Don't just let it slip back into general spending. Don't start eating at nicer restaurants just because you can. Like, hey, I've got the extra money. That's Parkinson's law. And that is a huge wealth destroyer. Building wealth, like real generational legacy wealth, is not about income. It's about discipline. I know pilots who make $400,000 to $500,000 a year who are broke. I just flew with one the other day who, if he's not flying above, crediting hours above the normal month, he doesn't make ends meet. And this was a captain, like he's making $500,000 a year. It's insane. I mean, I know other business owners who are doing 7 figures a year and they can barely handle a $10,000 emergency. It's because Parkinson's law has completely consumed their lifestyle, their consumption rate has completely consumed their income. It's nuts. On the other hand of that, excuse me, I know families who are making $80,000 a year and are building dynastic wealth because they understand this principle. Capital has to be directed intentionally or it disappears. When you commit to saving first in your family banking system and paying yourself back when the loans you take at market rate for the full duration, you're not just saving and paying off loans. You're installing discipline into a system. You're creating, a forcing function that makes you move capital through your wealth system, regardless of how you feel. When that loan gets paid off early because you were aggressive with the rate, you don't celebrate by going and spending. I mean, when I say this, I sound like a miser or something, and I do. I like to go have fun and do things. My point is like this: you're allocating this money towards building generational wealth. Keep that money in that place. Don't move it over to the fun money. You should have fun money. I don't want to sound like Dave Ramsey. Rice and beans is stupid. Like we get one life here. Enjoy some of your money, but not the money that's already allocated that you're creating discipline around. That needs to stay in this direction and keep expanding that because at some point you can have so much cash flow that you don't have to worry about how you're going to spend and enjoy it. Like you're far above what you need, and now you can really blossom. But still have the fun now. I recognize that sometimes we sound like misers, and by no means am I that. Um, Anyway, you celebrate, instead of like celebrating and going out and going on a trip to Vegas, like celebrate by redirecting that capital into the next level of your system. Because then your kids can really be doing some great things. So, I guess to recap, pay yourself back at market rates or higher. It maintains discipline, ensures true economic comparison, and that higher rate isn't costing you anything. It's accelerating your system. It's going into your life and your family's ecosystem. So pay the full duration of any loan, even if it's paid off early, even when that loan balance hits zero. The commitment you made was to move that cash flow through your system for X number of years or months or whatever. Honor that commitment. When your policy maxes out on PUAs, have a plan. Next year's premium, business deployment, investment opportunity, expanding your system, anything that strengthens your wealth building capabilities. Nothing that feeds into Parkinson's law. And just remember what EVA stands for, economic value added. Every loan you take should be creating value, not destroying it. Every payment you make should be building your system, not just satisfying an obligation. I mean, that's how you build a family banking system. That's how you create legacy wealth. And that's how you honor the capital that you and your family have worked so hard to build. If you're working with an IBC practitioner who tells you differently, who says rates don't matter, repayment is optional, or you can just do whatever feels right, run. They don't understand the system. They don't understand what they're building, because this isn't about freedom from discipline. It's about freedom through discipline. The Moody Family Creed, we talk about value, integrity, boldness, excellence, and service. Every single one of those principles applies here. You create value by building capital systems. You demonstrate integrity by honoring your commitments to yourself. You show boldness by thinking in generations, not months. You pursue excellence by refusing to let Parkinson's law steal your future. And you serve your family in the present and in the future by building something that outlasts you, hopefully outlasts your kids, your grandkids, and on and on and on. And that's what this is really about. So anyway, that's it for today. If this message resonated with you, please share it with somebody that needs to hear it. And if you want to learn more about implementing the infinite banking concept correctly in your own life, reach out. Let's talk. Go to remnantfinance.com, jump on our calendar there. Also, like, share, subscribe. This is Bryant Moody with Remnant Finance. Keep building the remnant. Keep funding the remnant. See ya.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
This is Brian and Hans signing off.